This is a short video to explain why the price of Bitcoin is going up so fast relative to other goods. So first we have to understand what is an economic good. A real economic good is a good whose supply is free to fluctuate in response to changes in demand and price. To put it another way, a real economic good is a good whose supply is unconstrained by forces outside the market, so it can fluctuate in response to market forces. So what are some examples of some real economic goods? Some real economic goods are things like food, clothing, automobiles or transportation in general, furniture, and these sorts of things. These are things whose supply is determined in the market, and they are unconstrained. The supply of these goods are unconstrained by forces outside the market, so they can fluctuate. So let's take a look at a quick graph to see what this means. So the graph of a real economic good, we want to see how the price of a real economic good is determined. So for any real economic good, there's a demand. This is the consumer demand, right? These are people who want to buy this particular good. And whenever there's a demand, there's going to be entrepreneurs, there's going to be producers, suppliers that are going to supply that economic good. Whatever it is, doesn't matter. It could be bread, right? It can be anything. The intersection of supply and demand, this is classic economic principles, is what we call the equilibrium point. And it's at that point that price is determined and how much is going to be on the market is determined. So suppliers supply to meet demand, right? Basic economic principles and analysis, nothing new here. So in the short run, what happens with a real economic good when demand goes up? For whatever reason, there's a number of different reasons why demand for any good would go up, would increase. But what happens to a real economic good when that happens in the short run, right? In other words, immediately. Well, when demand increases, let's call it demand star now, it's a shift to the right, actually, of the demand curve. What we see is an increase in price and an increase in the quantity that gets supplied to the market, which is expected. In the short run, suppliers, producers, they have their existing inventories, and when more people come and demand it, well, then they can charge higher prices. And they'll use their existing capacity, their existing infrastructure, to increase the quantity they supply to the market in the short run. There's going to be a limit to how much that they can supply because they have fixed factory sizes, they have fixed storerooms, they have a fixed number of employees, variable inputs and fixed inputs. And so in the short run, it's more difficult to increase supply as a whole, but given their existing infrastructures and capacity, then they'll increase as much as they can. Others with available unemployed economic resources will see the increase in price of this particular good, and they'll reallocate those resources towards this good because the higher price means a potential for profit. So the higher price attracts resources into the market, and in the long run, supply will also shift to the right, just like demand did. In other words, supply increases for the entire market. What this does is it brings price back down. It's not going to be exactly back down to where it was initially, but the idea is that what we'll see here is that there will be a decrease in price. And so over time, what we're going to see with a real economic good is price will fluctuate like this, but it's going to stay around some average, some mean, right? The fluctuations can be anything, right? But the idea is that we're going to see a steady or stable fluctuation in prices. Okay, this is normal in any market for any real good. And when price increases, we get an increase in the quantity that gets supplied to the market. So with real goods, we see more stable prices and greater increases in the quantity of the good that's supplied to the market. In contrast, an artificial good, an artificial economic good, is a good whose supply is constrained by forces outside the market. So it cannot fluctuate in response to changes in demand and price. So, what are some examples of artificial economic goods? Well, the money supply. Um, the supply of money in circulation at any point in time is not determined by market forces, by demand and price. It's simply a policy that's decided upon by a central bank's governing board. Just a bunch of guys sitting around saying this is how much money is going to be in circulation at this point in time. Government bureaucracies, governments issue bonds, and again, the number of bonds that are supplied to this bond market is not determined by the market itself. It's again just a bunch of people sitting around saying we're going to issue this many bonds. Corporate financial boards, because corporations issue stocks and bonds, the same thing. There's just some governing board that says we're going to increase the number of stocks in circulation, we're going to split the stocks, we're going to issue more bonds. So it has nothing to do with what's actually going on in the market. And cryptos, I hesitate to call them cryptocurrencies, so I just call them cryptos, whatever. Their supply, again, is not determined in the market. There's just what's called business rules, which are the same as the policies of these other constraints that are programmatically built into the software that limits the supply of the crypto. So these crypto things, the supply is completely mutually exclusive from what's going on in their markets, completely insensitive to what's going on in the market. The supply is always the same according to the business rules at any point in time. So let's take a look at the same price graph for the artificial economic good that we did for the real economic good. So just like for a real economic good, there's a demand for artificial goods, right? But the big difference here is the supply. The supply is vertical. It's a vertical supply curve. And this is because, again, this represents the complete and total insensitivity of supply to market forces. In other words, regardless what demand is, supply is always going to be the same because it's decided outside the market. And then it's just supplied to the market, and that's what it is. We call this a perfectly inelastic supply. In other words, it's not flexible in the market. It's not bendable. It's not pliable. It is what it is because it was simply given to the market, and the market has no influence over it. It's a fixed supply and it's a vertical supply. And just like with the real economic good, there's some equilibrium price, and the quantity is deterministic. It's already determined, right? So the price is determined solely by demand. So in the short run, the price and the amount that's supplied to the market is the same as in the long run, right? The amount that's supplied to the market is the same in the short and in the long run. The price will fluctuate, but the amount supplied is the same. Unlike with the real economic good we saw in the long run, in the short run prices went up, but in the long run they came back down. What we see with the artificial economic good is that whenever there's that same increase in demand, right, the same increase in demand, you can see there's a much more significant increase in price. And that's due to the inelasticity of the supply, right? And this is in the short run and in the long run. In other words, since supply doesn't respond to this increase in demand because it's not determined in the market itself, when the price goes up, it just stays there. There's nothing to bring it back down. There's no market mechanism to offset the increase in demand in order to bring prices back down. So we see these prices go up and they just stay there. This is the problem with artificial economic goods. So let's take a look at these two graphs side by side. And I tried to get these as even as possible. I think if you draw this across, you'll see this initial price is at the same level. The graphs are level here. And so this is the short run for a real economic good and an artificial economic good. And we can see in the short run that for any increase in demand, the price of a real economic good goes up by some amount. It's this amount here. All right, that little bit there. For the same increase in demand for an artificial economic good, then the increase in price is much larger. It's here, right? So you can see those two differences, right? That little bit for a real economic good, this much for an artificial economic good. And we see in the real economic market, for the real economic good, we see that there's an increase in output, which is good, that's great. But for the artificial good, quantity stays the same. It doesn't change because it's fixed. So why is the price of Bitcoin going up so quickly and so fast? Well, Bitcoin, being an artificial good, has a fixed supply in the market. And so for any given level of demand, like with any good, even the artificial goods, that provides an equilibrium price in the market. And we saw that for any increase in demand, then the price increases disproportionately. Well, what's happening with the stock market and Bitcoin, both being artificial economic goods, is they're reacting to the inflationary monetary policies of the Federal Reserve. So in the year 2020, the Federal Reserve has created 21% of all US dollars in circulation. Almost a quarter of all US dollars in circulation have been created just in this year. Given that the politicians have destroyed the economy, the central bank is trying to monetize the solution by simply pumping more money into the economy so that people have money to spend. Whenever the money supply is increased, that increases demand across all goods, real and artificial. Everybody has more money in their pocket, and it's chasing the same amount of goods that were out there beforehand. So it increases demand and drives pressure on prices, and prices go up. But we know with artificial goods, the prices go up disproportionately. So as the Federal Reserve has been inflating the money supply, then the demand for Bitcoin has gone up for a couple of reasons. First of all, because people are increasing their demand for all goods, and the Bitcoin blockchain is used to buy and sell goods. And Bitcoin is a complementary good for the blockchain. You can't use the blockchain without Bitcoin. So as the demand to buy and sell things on the blockchain goes up, so does the demand for Bitcoin. And given that demand, for that increased demand for Bitcoin due to the increase in the money supply, we can see and we learned and we saw that as demand goes up and up and up, that price continues to go up and up as well. But the price goes up disproportionately relative to the real economic goods, right? The real economic goods, the prices will go up, but then in the long run, we'll see that supply will adjust to bring prices back down, right? But that's not happening with Bitcoin because it's an artificial good, or the stock market, right? So what happens is the price just keeps going up and up and up, and at some point, this consumption demand, in other words, demand to get Bitcoin in order to use it on the Bitcoin blockchain, is overshadowed by people's speculative demand for Bitcoin. In other words, they see how fast the price is going up relative to real economic goods, and so they decide to hold the Bitcoin rather than using it on the blockchain in an attempt to profit speculatively. And realize there's no cost to holding Bitcoin, because there's absolutely nothing else that you can do with Bitcoin except use it on the Bitcoin blockchain. In other words, there's no cost. There's no opportunity that you're missing out on by holding Bitcoin. For example, if you buy land, there's a number of different things you can do with it. You can buy land for speculative purposes and just hold it and hope the price goes up and sell it later for a profit. But there's other things you can do with land that you might be able to profit from as well. And if you don't do those things, you could end up losing out, right? You could lease the land, you could farm the land, you could develop the land, right? So there's opportunity costs associated with just holding a real economic good. But with Bitcoin or any artificial good, there's no opportunity cost. You can hold it and you're golden, right? There's no cost to holding it. So as you see price going up much faster and much more disproportionately than compared to real economic goods, then you're going to decide to hold it. Your demand shifts from a consumption demand to a speculative demand, and then the demand keeps going up, and the price keeps going up, and the demand keeps going up, and the price keeps going up, and there's nowhere for the price to go. There's no way to bring it back down. So this speculative demand has taken over now, and the more and more people demand it for speculative purposes, the higher and higher the price is going to go. So this is the phenomenon that has happened. Nothing wrong with it. If you want to buy in for speculative purposes and try to profit, great, nothing wrong with that. Just realize that just the same way the price went up so quickly and so disproportionately, that's the way it comes back down, right? This is what's called a financial bubble. This is why artificial goods create financial bubbles. This was the 2007 and 2008 created by the Federal Reserve, increasing the money supply the way they did. So this is a classic financial bubble. And it will burst. The bubble will burst at some point. Considering the way that the government has decimated and devastated the economy, I think the central banks are going to keep pumping money into the economy for some time to come. So we can expect these prices to keep going up and up. But realize it's not real value, right? It's just speculative demand. People trying to profit. They're just buying Bitcoin, holding it, waiting for the price to go up, and then they'll sell it. Also realize that there's a lot of, one of the best things about Bitcoin is it's permissionless, which means anybody can have a Bitcoin wallet and use the blockchain. One of the worst things about Bitcoin is that anybody can have a wallet and they can use the blockchain. And they do. So realize that there are very large financial interests that have wallets and are buying and selling Bitcoin on the Bitcoin blockchain, right? We're talking banks, central banks, government institutions, financial whales, and so they're driving this as well. And at any point, those guys can dump their holdings. This is called a pump and dump, all right? And the people with the financial resources will drive these prices up disproportionately, and then when they dump them, then the prices come back down just as quickly and just as disproportionately, right? So in the long run, it's a risky business, right? But this is the mechanism, right? This is the mechanism. This inelastic supply is the mechanism that drives these wild price swings versus the more stable price swings of the real economic goods.